Greetings, everyone, and welcome back to all of you. So, today we rejoin again for understanding the paper Income Tax 2. We have already in the previous semester or in the previous sessions courses, we have completed Income Tax 1. Now we have to follow up the second part or the second half of the income tax, where we are going to discuss about the remaining topics that were left under the first income tax 1. As we talked about that, the total income, in order to compute a total income for assessing the taxable liability or maybe the tax amount, we have to have 5 heads that have to be computed or understood: salary, business, profit and gains of business and profession. Then next we had income from house property. These are the 3 heads which we have already completed in the first paper or the first course. In that paper, we also understood about the basic terminologies, the tax planning, evasion, avoidance, etc. But now we continue to the 4th head, that is the capital gain tax, as well as the income from any other sources. These are the 5 heads which accumulate together or which are total together in order to compute the total income of any SSC or an individual or an HUF or a firm. And once they are totaled up, on the basis of this total income, gross total income, we compute the taxes on the basis of that total income. So let us move on to the next topic or the next head. Continuing to that, that is capital gain tax. What is, first let us understand what is capital gain tax. So the capital gain tax refers to any tax that is imposed under Section 45 of the Income Tax Act 1961 on any profit or gain arising from the transfer of a capital asset. Actually, the capital asset is defined under Section 2, subsection 14, and includes property such as land, building, shares, and scrutinies maybe, while the transfer is defined as under Section 2, subsection 47. So such capital gains are chargeable to tax under the head capital gain in the year in which the transfer has taken place. It is also subject to certain exemptions and special provisions. There are some special provisions also of the acts, which we are going to discuss in detail under this topic. So first, let us understand what is capital asset and how is it defined and what all it includes. So capital asset, to begin with, it includes any kind of property that is held by an SSE. This means that a capital asset will include any property of any nature, whether it is movable or immovable or tangible or intangible, or may be owned or held under some rights. The purpose for which the asset is held is irrelevant. Even assets not used for business or profession qualify as the capital asset. Maybe the land, building, house property, vehicle, machinery, even jewelry, patents, trademarks, uh, copyrights, maybe goodwill, leasehold rights, manufacturing license. Is that maybe the second items that can be included are securities which are held by foreign institutional investors, FIIs. So securities held by FIIs are treated as capital assets provided the investment is made in accordance with the organizations framed under the SEBI Act 1992. It has to be as per that norm. Because this provision, it ensures that capital gains arising to FIIs on the transfer of securities, they are taxable under the head capital gains, even if such securities may otherwise appear to be trading assets. Uh, for example, we can say equity shares, debentures, bonds, government securities, and derivatives held by the FIIs as per the SBI regulations. Uh, this is a comprehensive inclusion of capital assets. Now let us understand what are excluded, what things are excluded, or maybe they are not included under the capital assets. That is maybe in spite of this comprehensive inclusion, the Act very specifically excludes certain items from the definition of capital assets. For example, the stock in trade, consumable stores, we can say, or maybe the raw material. So assets such as stock in trade or maybe raw material, they, when they are held for the purpose of doing business or any profession, then they are excluded from the capital assets. So any profit on their sale is taxed under the head business income, as we discussed in the previous course, that is PGBP. Okay, so it will not be taken as the capital gain part. Then another item that is excluded is the movable property that is held for personal use. Movable personal effects held for the personal use by the SSE or dependent family members are excluded. So, for example, clothes, furnitures, household utensils, they are, but exceptions are here. Yes, as I already said, the jewelry is included as a capital asset. Archaeological collections, drawings and paintings, the expensive ones, the sculptures, they will be included, or they are considered as the capital assets, even if it is held for the personal use. So this is an exception from other items. Then next item which are excluded are maybe the specified gold bonds and special bearer bonds. Specified the following, maybe we can say that gold bonds issued under the Gold Deposit Scheme 1999. Then another item is special bearer bonds 1991, and any gain on their transfer is not chargeable under the capital gain. Another item is agricultural land in India, rural agricultural land. Please remember this. That is, agricultural land which is situated in rural areas is not treated as capital assets. However, agricultural land situated in urban areas within a specified municipal limits or distance, it is treated as capital asset, and it is taxable accordingly. Okay. Another item can be your deposit certificates under the Gold Monetization Scheme 2015. Deposit certificates which are actually issued under the Gold Monetization Scheme 2015, they are excluded from the definition of capital assets. Hence, any gain arising from them, from their redemption maybe, or maybe if there is a case of transfer, is not taxable as capital gain. So now we can, I think clearly you can make out that what are the items that are exclusively included and what are the items which are exclusively excluded from the definition of the capital asset. So we can say, we can conclude it like a capital asset includes almost all forms of property held by an SSE except those specifically excluded by law. Here I should say that the correct identification of the capital asset is very essential. Just a small tip for you, it is very essential as capital gain tax arises only on the transfer of capital assets, not anything else under section 45. Okay, so I hope this is clear that what and how we define the capital assets and what are included or what are excluded. Now, as we discussed in the previous, we talked about this item number D, that is what are excluded. So land, how do we decide the agricultural land and rural areas? So this is the chart that explains you well. That is with effect from 2014-15, any area which is outside the jurisdiction of a municipality or cantonment board have a population of 10,000 and more or more is considered as a rural areas. So it should not be, but it has certain kilometers limit. It should not fall within that distance as per this. That is, shortest aerial distance should be if the population is less than 10,000, it should be within 2 kilometers. Beyond that 1 lakh, it is 2 to 6 kilometers, and then with 10 lakh above, it is 6 to 8 kilometers. Now, coming to another important point, that is basis of charge of capital gains. That is, on what basis is the capital gain taxed? So, under the Income Tax Act 1961, the capital gains are chargeable to tax only when certain essential conditions are fulfilled. And these conditions, they form the basis of the charges as they are before you. First point says the assets transferred should be a capital asset. The first and foremost condition is that the asset transfer must be a capital asset as defined under section 2 subsection 14 of the Act, as we have already discussed just now. They include, as already discussed, the property of any kind, whether movable or immovable or tangible, intangible, for example, land, building, shares, security, jewelry, patent, trademark, etc. If they do not include, they are not included or is specifically excluded, for example, stock in trade, rural agricultural land, and personal or any personal effects other than jewelry, then the capital gain tax is not attracted or it is not there. For example, maybe if you are selling your stock in trade, it is taxable as business income and not as the capital gain. So first thing is this. Then second basis it should be transferred. The capital asset should be transferred by the SSC in the previous year. That is the term transfer. Now, first we will understand the term transfer, but it has to be by the SSC and during the previous year. I hope you all remember what is previous year and who is an SSC, because we already discussed all this in the terminology part. So now today I am going to explain you about this transfer also. So the term transfer is defined under section 2 subsection 47, which says it includes any kind of sale, exchange or relinquishment of the assets. It also includes any compulsory acquisition under any law. For example, if the government is going to suppose build a bridge in certain area and your land falls, your agricultural land or your house falls within in that domain, they are going to compulsorily acquire it from you and they will pay you certain compensation. This compensation will be computed, and whatever capital gain is there, you will have to pay taxes on that. Okay, similarly, conversion of capital assets into stock in trade. Maybe, for example, you are dealing in you own certain pieces of land, and now you one day decided that okay, I'll be doing business dealing in land. I'll be selling and purchasing the lands. That will be a part of my business. So maybe you convert it into stock for your trade. So that is conversion on. So whatever is you're gaining on that, you will be taxed as capital gain. So another example can be allowing the possession of immovable property in part performance of any contract. maybe. So capital gains are usually they are chargeable in the year in which the transfer takes place, even if the consideration is received later, which we said that it has to be in that year. And for example, maybe if a house property is sold in March 2025, then the capital gain will be taxable in the assessment year 2025-26. Then another point, relevant point that must be mentioned here, that is basis of charges. The third point, there should be profit or gains from the transfer, because that is the amount that is to be taxed. So the third condition is that the transfer must result in profit or gains to the assessee. The capital gain arises only when the full value of consideration received or accruing on transfer exceeds the cost of acquisition, and other allowable deductions such as cost of improvement and transfer expenses, they are all adjusted. So if there is no profit or if the transfer results in a loss, then obviously no capital gain tax is payable, though the capital loss may be set off or carried forward as per the provision of the act. So maybe it will benefit you to maybe write off if it is allowed to be carried forward. For example, suppose if a property is sold for less than its cost of acquisition, it results in a capital loss, not in a capital gain, obviously. So we can say that the capital gains are chargeable to tax under section 45 only when it is a capital asset, that is, it has to be a capital asset. If it is secondly, if it is transferred by the assessee during the previous year and the transfer results in profit or gains. Failure to satisfy any one of these conditions, the 3 points that are there before you on the screen, any one of these conditions means capital tax, gain tax will not arise. Okay. So this is about the important, these are about the important basis of charges. Next, we come to understand the classification of capital assets. That is, the capital assets are divided or may be classified on the basis of time period, that is short-term capital asset and a long-term capital asset. It is these different sections, that is, they are there, section 2, subsection 42A, and second is section 2, subsection 29A. So this defines or classifies on the basis of time period, that is for how longer you hold an asset. That decides whether it is a short term or a long term capital asset. So let us just understand that. Coming to the classification or maybe a detailed understanding of this, we can say that it is, as I said, it is classified on the basis of period of holding into holding of that asset. So a short-term capital asset is a asset which is held by the assessee for not more than certain specified period. Now, period of holding are differently defined. Maybe in general it is not more than 36 months, that is 33 years. Not more than 24 months if it is an immovable property. Immovable property means land and building, and it should be maybe it should not be more than 12 months if it is a liquid asset. Liquid asset means shares, listed equity shares, unit of equity oriented mutual fund, listed securities, etc., as specified in the proviso to section 2 subsection 42A. Now, what are included under long-term capital asset? Obviously, beyond these limits, it is long-term capital asset. It is anything that is not a short-term capital asset, or we can say it if it is held for more than the period that has been defined. So more than 36 months in general, but if it is a specifically immovable property, then more than 24 months, and if it is liquid assets, shares, equity, mutual funds, listed securities, etc., more than 12 months. So this is how we classify on the basis of for what duration the asset was held. On the basis of that, we categorize them as a short-term and the long-term capital asset. Coming to in more detail that how do we compute about the capital asset, short-term capital asset and short-term long-term capital asset. When a short-term capital asset is transferred, I hope you all, the definition of transfer is already clear to you. That is when the short-term capital asset is transferred and the sale consideration exceeds the cost of acquisition and other allowable expenses, then the resulting surplus is called short-term capital gain. So after transfer, you can compare the cost price and the selling price, which we called, the cost price is called cost of acquisition and the selling price is full value of consideration. So here when we are computing it as per section 48, full value of consideration from the amount that is selling price or full value of consideration, we deduct the cost of acquisition, the cost of improvement, expenses on transfer, etc., and we get the short-term capital gain. Here in this short-term capital gain, we do not take into consideration the indexation benefit. Now, what is indexation benefit? Actually, this is to take into consideration the time value of money that has to be computed, and we will understand this in detail later on. So coming to the next part, that is short-term capital as a 12-month rule. Actually, there is a revised, provision that is there. So let us understand this. So under the provision of the Income Tax Act, the classification of the capital asset as short-term or long-term depends primarily on the period of holding, as discussed. While the general rule prescribes a holding period of 36 months, whereas we have already discussed that there are certain specific assets where which are given preferential treatment due to their high liquidity and maybe active trading in organized market. So for such an asset, a reduced holding period of 12 months is also applicable, as we have already seen that. This concessional rule applies to specific categories of financial assets, namely listed equity or preference shares, listed securities such as debentures, bonds, and government securities, or maybe units of UTI, that is Unit Trust of India, or units of equity-oriented mutual funds and zero coupon bonds. Here, a notable aspect of this provision is that in the case of Unit Trust of India units, equity-oriented mutual fund and zero coupon bonds, here the benefits of the 12-month holding period applies whether or not these instruments are listed on a recognized stock exchange. If I would say here that if any of these specified assets are held for a period of 12 months or less, they are classified as short-term capital assets, and any gain arising from their transfer is treated as short-term capital gain. Conversely, if the holding period exceeds 12 months, then the asset is regarded as long-term capital asset and the applicable tax treatment changes accordingly, including indexation, etc., as I said. To understand this practical term, or maybe to concept, consider an investor who purchases listed equity shares on 1st January 2025 and he sells them on 30th September 2025. Okay. Since the shares are held for only 9 months, that is between January to 30th September, it is only 9 months, and fall within the specified category, they will be treated as short-term capital gain. So, in contrast, if unit of an equity-oriented mutual fund are purchased in April 2025 and redeemed in May 2025, then the holding period exceeds 12 months and therefore this asset will now qualify as a long-term capital asset. And the gain will be computed under the heading of or under long-term capital gain. The rationale behind prescribing a shorter holding period for these financial assets lies in their marketability and the liquidity character. These instruments are frequently traded and form an integral part of capital market, where investment horizons are often shorter, very short. Recognizing this, the law provides a reduced threshold to determine their tax treatment. Okay. For academics and exam, maybe understanding purpose, maybe for a student purpose, it is very important to evaluate these three key elements while determining the nature of capital assets, the type of assets, the holding period, and whether it falls within the specified category which is eligible for the 12-month rule. So, I think a very clear understanding of this is very crucial because it directly influences the computation of capital gains and the applicable tax rates. So, we discuss this much today, and we'll continue to the same in the next session. Thank you.